Okay, folks, welcome. And I assume if you're here, you've already taken the test, so I won't talk about it. So today we're going to continue and probably finish almost the rest of the dark side of valuation. We have quite a few scenarios to look at. We're going to start with mature firms and commodity companies and financial service companies. And along the way, I'm probably going to hit one of your companies because, the company you're doing your project on. So if you still have issues, hopefully by the end of today, those issues will maybe not be resolved, but will be lesser. So this is your chance. If you have a financial service company or a commodity company, to ask questions that might help you on your project. Okay, so let's see where we were. We were talking about the valuation. I did my valuation of Amazon, and it led you through the process of what I learned from that Amazon valuation in terms of how to estimate reinvestment rate and growth and margins. And I admitted that, making a lot of subjective judgments along the way. Okay? So we're going to continue with that discussion, but let's start today's session with our typical start of the class test. So these questions are all going to relate to discounted cash flow valuations. So there's my first one. When you look at commodity companies, and today we're going to look at Royal Dutch, their earnings move up and down with commodity prices. That's a given. Okay? Now, so when you value commodity companies, you'd expect the commodity price cycle to matter. But let's assume there is a price cycle. Oil companies go up, oil prices go up, oil prices go down, coal prices go up, coal prices go down. If there's a cycle in commodity prices, should there also be a cycle in commodity values? You see what I'm asking? I mean, I'm admitting up front, prices of commodities go up and down. Let's say they go in a cycle. Will values also go in a cycle? Neil, what do you think?
I don't think the value should go up and down in a cycle.
And give me the reason why. In a rational environment, why should it not? You're right, it shouldn't. But what is it that drives us to that conclusion?
You're valuing the company based on its cash flows and its fundamentals, and if everything stays constant, unless your risk and all those factors are changing, the risk-free rate, and those things, the size of the business cycle or the industry cycle shouldn't. There's no component in there to affect the FCF.
In other words, if cycles were predictable and we all thought cycles is played and replayed out, value should remain pretty stable. But here's the empirical reality. It doesn't, right? We see the prices of commodity companies go up and down with cycles. When earnings are bad, you tend to see oil prices trade at lower, companies trade at lower prices. When they go up, you're saying, does this mean investors are not rational? Not necessarily. Because the key word that I use is if cycles are predictable. Now, I'll give you an example. Between 2003 and 2013, there was this huge upward trend in commodity prices because of China's infrastructure spending. It drove up the prices of oil, it drove up the price of iron ore, And if you looked at that cycle, you would have been consistent. So if you came into 2004, so prices are too high, I'm not going to buy an oil company. 2005, you'd effectively had to sit out the market for about 10 years before the cycle relapsed. So to the extent that cycles are unpredictable and volatile, you still have some degree of feedback effect depending on where you are in the cycle. It's better to be at the top of the cycle than the bottom of the cycle if you're an investor, because if you're at the bottom of the cycle and the cycle doesn't come back, you're kind of stuck. So we're going to talk about how to kind of keep that commodity price view out of your valuation today. But we'll use Royal Dutch to illustrate that. Let's do a second scenario. You're valuing a distressed company. Many of you are valuing distressed companies. You make what you think are realistic assumptions about revenues and margins and cash flows and discount rates. So you're valuing Bed Bath & Beyond. You make realistic assumptions. And what do the realistic assumptions look like for Bed Bath & Beyond? That they're going to shrink over time, their margins are going to get smaller over time. So being realistic, you come up with a discounted cash flow valuation for Bed Bath & Beyond. Say that value is $1 billion for the equity. Given that it is a distressed company, is all this debt overhanging it, is that $1 billion going to give you too high or too low a value for your company? And why? Sahir, what do you think? You've been realistic about this company. You come up with $1 billion in equity value. Is that value going to be too high or too low for the company?
I think it'll be reasonable because we account for the fact that it is a distress company.
Okay, so let's pause that. When you say account for the fact, tell me how you accounted for it, because your answer might be right. Let's see if you've accounted for all the things that need to be accounted for. So what did you do?
So very low growth, or
Very low negative growth,
negative growth, yeah, and
shrinking margins, maybe as competition urged. What else did you assume? Maybe assume the debt ratio would decrease
yes.
over time as the company paid down the debt, because as you get smaller, you got to pay off the debt. Maybe a high cost of debt reflecting the fact that they have a low rating. You built in a double B rating, so you have a higher cost of debt. But you're still doing a discounted cash flow valuation, right? Which means what do you do over time? You make the company a reasonably healthy company. You get to year 10 and you give it, it's a much smaller company, more realistic company, but you get to year 10, you give it a 2% growth forever or a minus 2% growth forever. You come up with the terminal value. You think, where is this going? Implicitly, what are you assuming? That this company will make it as a going concern. That's the implicit message. In everything you've done is you've done all the right things, but you're assuming they will make it as a going concern.
So
You know what you haven't factored in? What have you not factored in?
the risk they might just go bankrupt, or
That they might not make it, right? And do a lot of companies go bankrupt? Absolutely. You see what the biggest, I think, hole in discounted cash flow valuation is almost mystical belief we seem to bring in that every company will make it as a going concern, get to nirvana, the terminal value. We're missing. And that's why, if you look at my spreadsheet, this is an input you probably have never seen in a DCF, where I ask you, what's the failure probability? What's the chance your company will not make it? And if it doesn't make it, what will happen? The company gets liquidated, which means you're not going to get the cash flows. You're going to get the liquidated value of the assets. You net out the outstanding debt, the actual debt due. And if there's any money left over, you'll get it as an equity investor. But if there isn't any money left over, equity could be worth nothing. It's almost, I'm introducing almost a decision tree front to your discounted cash flow valuation. Remember decision trees in operations research or statistics? We have branches, right? Going concern, not going concern. Going concern, you get the DCF value. Not going concern, you get liquidation value. Now we can come back and talk about how to attach that failure probability. I'm not going to act like it's an easy number to estimate, but assuming it's zero is also an assumption. So when people say, I will not estimate a failure probability because it's so difficult to do, you just did. You put in a 0% failure probability. So don't tell me you're not estimating it. You're still estimating it when you're ignoring it. So we're going to talk about how to adjust for distress, and a discount rate is not going to do it. And finally, maybe towards the end of today's session, we're going to talk about emerging market companies. And one of the problems we face with emerging market companies, and not just with emerging market companies, even with some US companies, is you have zero power over how the company is run. You may think you're owners of the company, but only in name. Yesterday, I got an email from somebody who's tracking the Tata Group, where there's this big fight going on between the Tata family and this guy called Cyrus Mistry, who was one of the families that originally was part of the group, invested a lot, was CEO, got pushed out of the company. And his question was, whose side should I be pulling for? I'm a shareholder of the company. And my response was, these are both corporate royalty. Neither cares much about shareholders. No matter who wins, you're still corporate serfs. Shareholders and companies without any power, you worry more about your shareholding. The question is, what do you do? Should you be discounting companies which are badly managed and have poor corporate governance? Because it seems like that's a terrible investment to make. But let's say you have a company that's badly managed and badly run, and you come up with a discounted cash flow valuation reflecting those views. Should you be still attaching a discount for not having strong corporate governance? In other words, should you take your DCF and discount it for poor corporate governance. Matthew, what do you think? Matthew Center.
I think not, because it sounded like that's already reflected in lower cash flows.
And how is it reflected? Because not only is the company badly managed and badly run, I've left it badly managed and badly run in perpetuity. So when I got to my terminal value, my return on capital was less than the cost of capital. I kept them growing. So you're saying that makes no sense. I agree, but the family that's running the company has been doing this for 50 years. You can't get them out of the way. What makes you think that magically you can go in and adjust their debt ratio, target debt ratio, and make them run it optimally? So we're going to talk about how bad corporate governance gets baked into your discounted cash flow valuation, how attaching a discount is going to be double counting. So lots of things on our plate. Let's go back. To where I left you on the Amazon valuation. And the Amazon valuation, if you remember, I left you with a confession. I said, look, I valued Amazon. I'm going to be wrong 100% of the time, but I'm okay being wrong because I don't have to be right to make money. I just have to be less wrong than everybody else. Okay? So to illustrate how this played out, now I showed you my 2000 valuation when I valued them at $35 per share, and the stock was trading at 84. And if you remember, what did I do? I said, I think the company's overvalued, but then I did this little song and dance about not selling short because I didn't control my time horizon. Remember the 6 weeks I was given? 1 year later, I revalued Amazon. I told you, Amazon has been my lab experiment for 20-something years. Every year I revalue them. I revalued them, and here's what I found. My value went from 35 to 24. You're saying, that's terrible. You know why? The dot-com boom had bust, the economy had gone into recession. I brought in much lower estimates of growth and margins. My value changed. But before you jump on me for changing my value so much, take a look at what the market did. It went from 84 down to about $11 per share. The stock went from being massively overvalued to significantly undervalued. And I was trapped. Trapped in what sense? Because when I did this, and again, I did this with the CFA, the question I was asked was, are you buying? And there was no dancing around this. I couldn't use the excuse I used a year ago about only 6 weeks. I control my time horizon. I bought Amazon for the first time in 2001. It stayed in my portfolio. Now, I know in many old-time value investing books, what are you told? When you buy something that's good, you buy and just forget about it. I've never understood that advice. If you bought something when it was undervalued, if you stay true to that philosophy, how long should you hold it? Not forever, but until it gets significantly overvalued, right? And the only way to find out when that happens is by actually revaluing a company. I've just upped the ante on how much time and effort it takes to do active investing. Not only do you have to decide what to buy, but you have to revalue those companies over and over again. Every year, I have to revalue 50 companies. Those 50 companies in my portfolio, I have to revalue them every year because every year they've got to earn the right to stay in my portfolio for the next year. So a year later, I went back and revalued Amazon. My value went from 24 to 30. It had been a good year. But the stock price also went up, but it still stayed undervalued. So it stayed in my portfolio. 2003, I revalued Amazon again. It was an incredibly good year. My value went from 32 to almost $40, but the stock price went to 55. And if I was staying true to the notion that I buy something when it's cheap, it was time for Amazon to leave. That was my first go around with Amazon. I bought in 2001, sold in 2004. But nothing is forever. It was overvalued in 2004, it was undervalued in 2006. I bought in 2006, sold it. So this is what I mean about I bought Amazon 4 times and sold Amazon 4 times. It's over the course of the last 20 years. There have been times when I look at a company and say, you know what? Now's the time. But I also have to be open to the fact that 2 or 3 years later, now is the time. I've got to leave the stock. So I revisited my 2000 forecast. So as I said, I do this every year. And I very seldom look back at old forecasts because what am I going to learn? That I'm wrong? Of course, I knew that already. But once in a while, I go back and look at old forecasts. So in 2004, I decided to look at remember in 2000, the peak of the boom, I did the 2000 valuation. I decided in 2014 to do a look back on what I got right and what I got wrong. Okay, so it's a complete look back with everything that's happened over the 13 years. And here's what I saw. Now, so there's my forecast from 2000, when I took that tiny company and gave you that story about 6th largest retailer. So those are my forecasted revenues. Those are the actual revenues. So the first thing that happened is I projected 51.5 billion in revenues in 2000. They came in well above that. So what am I learning? That Amazon's growth story is much bigger than what I thought it was going to be. So in that dimension, I was being too pessimistic. But then I looked at operating income and margins. If you remember my original valuation, my margins are going to get to 10% in year 10 and stay at that. Here's what I saw with Amazon. Early on, they actually looked like they were moving towards what I thought they would. You can see the margins starting to improve. I thought in 2006 or 7, Amazon was well on its way to becoming a mature company with nice, solid margins. And then somewhere around 2009 or 10, there's something seemed to change dramatically at Amazon. You could see that in the margins. The margins that had been kind of maturing started to kind of decrease dramatically. And here's what the other thing that happened. Usually as companies mature, what happens to reinvestment? It starts to level off. So basically revenue growth goes down, reinvestment goes down, margins go up. And for the first 6 or 7 years that happened, but somewhere around 2009, 2010, it's almost like the company decided that it was going to reverse the life cycle. What that meant was they started reinvesting like they were a young growth company again. Their revenue growth popped up, their margins imploded. And I struggled with my Amazon valuations in 2011 and 2012 because I was still stuck on Amazon being a retailer, an online retailer. What the heck are they doing? In hindsight, I can see exactly what they were doing. They were reframing themselves as a company. In fact, in 2015, 16, when I valued the company, the story I told about the company was a very different story. Remember, we talked about story changes. This is the most dramatic story change I've had in my experience valuing a company. The story I told for Amazon, by the time I get to this valuation, is it's no longer a retailer. I described Amazon as a disruption platform. This is a company that will go after any business on the face of the earth if it feels that it can go in, disrupt the business, and make a profit. And I'll give you actually a survey that kind of backed up how scary Amazon is as a potential competitor. The survey actually looked at the 50 largest companies in the world, so financial service companies, retail companies, and they asked the CEO of each of these companies to name the 5 biggest potential competitors. So let's start with Walmart. Do you think they worry about Amazon? I think Amazon lives in Walmart's head. I don't think there's a single decision that Walmart makes that's for Walmart. It's about what would Amazon do here. Of course, Walmart worries about Amazon, number 1 on the list. What about UPS and FedEx? Do you think they worry about Amazon? Every single day. So you expected that, right? But here's the things I did not expect. They asked Disney to list their 5 potential competitors. You know who showed up in the list? Amazon. They asked JP Morgan for their 5 biggest potential competitors. You know who showed up in the list? Amazon. You say, why would JP Morgan be worried about Amazon? If you're a disruption platform, what kind of businesses do you target? Inefficiently run businesses that are fat in all the wrong places. I let you visualize what those businesses look like. And banks fit the bill. I still remember I moved to California in 2017 from New Jersey. And when I moved my bank account, obviously, from it's a Chase Bank in New Jersey to a Chase Bank in San Diego. I'm moving my money from one bank to another. You know how much that bank wire cost me, how much they charge me to move it from their New Jersey bank to their San Diego bank. They charged me $40. And I said, what? I remember I walked into the bank. I said, what did you do? Do you hire a guy, convert to cash and carry it across the country? What is this $40 for? It's highway robbery. That's what it is. That wire cost them absolutely nothing. You know why they charge $40? Because they can. Was I pissed off? Absolutely. Did I have any choices? Not at that point in time. But I'm biding my time. You know what I'm hoping and praying I'll get in my mailbox one day? I'm an Amazon Prime member. You know what Amazon Prime is? It's really a disruption army for Amazon. I'm waiting for that email from Amazon that says, we've decided to start Amazon Bank. Would you be interested? Do you think I'd be interested? I'm there in a second. Hey, let's face it, if Amazon had been in charge of vaccinating everybody in the United States, you'd have had overnight vaccines. You'd stick your hand out of the window, the Amazon guy pokes you in the arm. We'd all be vaccinated within 3 days, right? I mean, you can like Amazon, you can dislike Amazon, but the reality is they deliver value for your money. There are lots of things I can live without, but the one thing you cannot take away from me is my Amazon Prime membership. So you come after that. I mean, this is why when people talk about regulating Amazon, they underestimate the army that they're going to go after. How many people voted for Joe Biden last year to allow him to win the election? What, 80-something million? How many people are on Amazon Prime just in the US? 120 million. You piss off Prime membership full time, you're never winning another election, ever. This is a disruption army. And you know what that does, right? When you're a disruption army that can go after any business, what does your revenue look like? It could be trillions, right? You can't just say it's retail business. It could be retail, it could be financial services. We can debate what kind of margins you expect to have. And if you're conspiratorial, here's what the world will look like. Amazon Prime is the only game in town, and they're charging you $999 a year because you have no choice. Your margins could be huge. But that's really what changed my perspective on Amazon. What did it also do? Basically opened the door to a much larger valuation of Amazon. I remember the first time I did this, people said, now, aren't you concerned that your story shifted so much? And I said, it is what it is. I mean, I wish I could have seen this coming 5 years ago, but my guess is even Amazon didn't see this fully coming. And in fact, in September of 2020, at the peak of COVID, I revalued Amazon again. And the reason was very simple. As the rest of the world was melting down, you know what the FANGAM stocks are, right? Facebook, Amazon, Netflix, Google, Apple, and Microsoft, 6 companies out of 7,500 US companies. They accounted for 10% of all of the increase in market capitalization of all US companies in the previous decade. So coming into COVID, they were already strong. And guess what they did during COVID? Collectively, their market cap increased by $1.4 trillion in those 6 months between February and November. And I revalued Amazon in September 2020. I still found it overvalued, but surprisingly close, right? For a company that's gone up so much, the value that I got was $2,800 per share. The stock was trading at $32.60. In fact, the day after I valued Amazon in 2008-27, I put in a limit buy. You know what a limit buy is? You go into your online broker, you say buy, but you put a price. And I put in a price of $2,500. I came really close to buying Amazon. And that's what I would suggest you do. When you value a company you really like, even if the price is way off, it's actionable if the price drops. If you liked Viacom as a company 2 weeks ago, but you found it overvalued, you have your chance now. You know why I picked Viacom, right? You've been reading the stories about this Chinese family group office that's been buying shares with borrowed money, and now the whole thing has imploded. And Nomura and I think Credit Suisse are now trying to sell those stocks as quickly as possible to cover the debts. Viacom is down like 25% as a consequence. So you found it overvalued 2 weeks ago, go back and revisit it. If any of you valuing Viacom, your sell might very quickly have become a buy over the last 2 weeks because the price moved so much. So that's the young company analysis. Any questions before we move on to more mature companies? So let's talk about mature companies. Mature companies are usually easier to value. Why? They've been around a long time. They have lots of financial history. They're set in their ways. Right? That's what makes them easy to value. So when you do things like reinvestment, return on capital, you're basically saying these guys are actually acting on muscle memory. They're doing what they've done for the last 30 years. But there's a problem with being set in your ways, right? You could get set in, I have a lot of bad habits I've developed, too old for me to go fix those bad habits, but those are what they are. And if you're a company, you get set in your ways and those ways no longer work. The problem is you don't even realize it till somebody wakes you up. I still remember Blockbuster kept opening new stores for years after people stopped coming into Blockbuster stores because they're so used to opening 20 stores every year, they stuck with a plan. So what usually triggers re-examinations in mature companies is somebody pushing for change. So many of you might be aware that Kohl's is now being targeted by a group of activist investors who have this whole list of things they want Kohl's to do. And Kohl's has been around a long time. It's it used to be regarded at least as a fairly well-run retail company, but times have changed. So when you have a company that is in transition, where they're being pushed to change, here's the challenge you face. Whenever you ask, remember the 4 questions you ask about a company: what are your cash flows? What's the value of growth? How risky are you? When will you be a mature company? When you answer those questions, you get one set of answers if they remain set in their ways, because you can see what they do. But then you could say, you know what, but they're being targeted by Bill Ackman and he wants them to do this, this, and this. What will the value of the company be if they change? You can get 2 very different values for the same company, depending on who runs the company. So let's try this out. Right? You've heard of Hormel Foods? It's a company that's been around almost 100 years. It started, I think, somewhere in Buffalo, New York, as a sausage packaging company, but it became a very successful company by the middle of the last century. In fact, its 2 most famous products. One is Hormel chili, was introduced, I think, in the 1930s, but it's even more well-known product is one of the most disgusting food items known to man. It's called Spam. Have you guys seen? It's ham in a can. Think about that already. How do you put ham in a can with a shelf life of like 1,000 years? How you put ham in a can and give it a 1,000-year life, I don't know. I don't want to know. But Spam was actually created by Hormel for the US Army. And there's actually a very interesting story of Spam you could read when you have spare time, not right now. It was actually created because at the end of the Second World War, the US Army was trying to bring its soldiers back from the Japan front. And because they couldn't make it all the way back from Japan to the US, they had a stopover right in the middle of the Pacific. So what's the only stopover you can think of? Well, it was Hawaii. Hawaii at that time was just this kind of island where not many people live, so the stopover. The only problem in Hawaii is there's not that much food. And here you had hungry soldiers coming back in the hundreds of thousands, and they wanted food and they wanted meat. So the US Army put out a requisition for a company to come up with a meat that could actually feed soldiers and stay. You'd have to be able to store it. There wasn't enough refrigeration, and Hormel came up with Spam. It's a long-winded way of saying this company's been around a long time. It used to be a family-run company. Now it's run by management, but there's a big family. Hormel family still own. It's set in its ways. It's a very conservative company. So in 2014 or 15, I valued the company first based on the existing management running the company. And what did I do? I assumed a fairly conservative management because that's what they'd been doing. A low debt ratio. The debt ratio was about 10%. A very low reinvestment rate because they really weren't daring. They didn't want to push their products into other markets. They were very happy with just the domestic market. So low growth, low reinvestment, low risk, low debt ratio. And with that assumption, the value that I got was about $32 per share. So it's a low growth company with fairly low risk. But there was talk at least at other food processing companies that have been targeted that the change was coming, that you should not be so conservative about reinvestment. You should go for a global market and perhaps be willing to use more debt. So I did a second valuation of Hormel, assuming two big changes. One is that they'd reinvest more and become more aggressive in their growth rate, giving them a higher growth rate and a higher reinvestment rate, and that they would use a little bit more debt. So instead of using 10% debt, that they would use a 40% debt ratio. And I'll tell you how I came up with the 40 and not 30 or 50. So with those two changes put in, a higher growth and a lower cost of capital, the value that I got was about $38 per share. I have two values per share, and they can't coexist in the same word. A $32 value with the existing management running the company, and a $38 value with a very different management. The stock was actually trading at about $34 per share. A quandary here, right? If I compare the 34 to the 38, it looks cheap, and the 34 to the 32, it looks expensive. So here's how I broke the tie. I estimated a probability of change of only 10%. And I'll tell you in a minute why it was so low. I said change might come, but there's a very low probability of change. My expected value then is 90% times $32 because the existing management is going to stay on, and 10% times $38. Now let me talk about why the probability of change is so low. What will cause this company to change is if enough shareholders get pissed off enough that they can throw out the existing management. The largest single shareholder in Hormel was the Hormel Family Foundation. The family, in fact, was very slightly involved with the foundation. They were living off the wealth. So the chairman of that foundation is going to have a pretty strong role in how Hormel is run. So I looked to see who the chairman of the Hormel Foundation was. It was the CEO of Hormel, and my stomach dropped. Because if you're a Hormel shareholder, you can already see your chances of change dropped off because the person running the foundation that controls most of the shares is also the CEO. You're saying, what would have given you a different perspective? I looked at the shareholders, and the largest single shareholder was Carl Icahn. I'd have switched these numbers. It would have been maybe 30% status quo, 70%. Now you can see why knowing the shareholder composition can affect whether you invest in a company or not. Because especially with mature companies, you can get very divergent values depending on who's running the company. Now, staying on this theme of valuing mature companies with change, a couple of cautionary notes. One is whenever you go into a mature company, it's easy to talk about cutting costs. It's much more difficult to actually deliver. You know what I'm talking about? Often when activists target companies, my sympathies sometimes lie with the restaurant or the retail companies it's targeted, because these actors come and say, why don't you cut costs by 30%? What costs? What exactly does that mean? That 2 cooks instead of 3? Will that mean that people have to wait for 45 minutes instead of 30 minutes? So McKinsey actually did this study on cost cuts that are promised. When you see a big restructuring announcements, companies that we're planning to cut $300 million in costs. So what McKinsey did was it looked at what percentage of these companies actually deliver on their cost cuts. And it found that's a very small percentage of companies that promise cost cuts actually deliver. And then in this study, they looked at what the key variables were that determined whether a company delivered on its cost cuts. And I'm not saying there's much you can read out of this, but what they were looking for was specificity. Companies that were more specific about where they would cut costs were more likely to deliver on them. Companies where management also absorbed some of the cost cuts. You know what I mean by that? Took a cut in salary, basically took less in bonuses, were more likely to deliver than companies where management passed off the cost cuts to everybody else in the company. So if any of you are valuing companies where you've seen a restructuring announcement, big cuts in costs, now don't take the cost cuts as a given. So when they say we'll improve margins from 10 to 15%, easy to say that up front, much more difficult to deliver in practice. Well, the other dimension that mature companies look at is growth, right? Like maybe we can grow faster. Be very careful when mature companies try to reorient themselves and make them growth companies. Because growth is easy, right? All you need to do is do acquisitions, go into new markets, sell stuff at a lower price. But remember, for growth to add value, what's the other component that has to come through? Your returns on that invested capital have to exceed the cost of capital. For many mature companies, the best way to value enhancement is not to grow, but to shrink. It goes counter to everything we're taught in management, right? Every Harvard Business School case is about how do we grow? How do we sustain ourselves? To which my response is, what's this big deal about sustaining yourselves? You're a corporation. If the reason for your existence is gone, why would I want you to sustain yourself? So when you look at the cost-cutting option, be skeptical. When you look at growth, make sure this is the kind of company that can grow and increase value. And finally, one of the most common mistakes I see in restructuring valuations is how people compute cost of capital. You know, we take cost of equity, cost of debt, we take weights in debt and equity, right? If I leave the cost of equity and the cost of debt fixed, and I just change the weights, you know what's going to happen, right? As I move from equity to debt, my cost of capital will always go down. This is why when analysts value companies that raise the debt ratio, the cost of capital almost magically always goes down. But it's a mistake. And those of you in my corporate finance class know what you need to do. When you change the debt ratio, you got to play this dynamic game of, if my debt ratio changes, what will happen to my cost of equity and what will happen to my cost of debt? Because those numbers are not fixed. They will change with your debt ratio. The cost of equity connection is very simple. It's through your levered beta. As you borrow money, I re-lever your beta, and the more you borrow, the higher your beta, the higher your cost of equity. On the cost of debt, it's a little more indirect because it comes through your default risk, but that's why we did the synthetic ratings. As your debt ratio changes, your rating will change. So in the case of Hormel, rather than just assuming that a higher debt ratio is good, here's what I did. I computed the beta at every debt ratio, the rating and the cost of debt at every debt ratio. And you know why I picked 40%? Because their cost of capital is minimized to about 38% debt, somewhere around there, between 30 and 40%, closer to 40 than to 30. So my choice of 40% was not random. It was not based on industry averages. It was not some target debt ratio picked out of the air. It came from reflections of what I thought would happen to the cost of capital as you increase the debt ratio. So any questions about mature companies? Because some of your companies are going through restructurings. There's an issue you're going to face up to. What should I assume about the future? If it's really one of those, you know, it depends on who runs the company, it's better to actually do 2 valuations and then take an expected value based on the likelihood of change in this company.
Professor, sorry, can you just explain again why it's sometimes better for them to shrink? I'm not sure I fully followed that part.
Well, let's suppose you're in a bad business. You're earning less than the cost of capital. Let's say you're a retailer, right? Every store you have is an investment. That store has capital investment. Let's say in your stores, you're making, let's say on your urban stores, you're making a 6% return on capital and your cost of capital is 9%. On your rural stores, you're making 11% return on capital. It's still a good business, but in the rural, if you're not in the cities. What's the best way for you to increase your value as a company then? It's not
Right, so
go
basically
open
just-
more. Yeah, go ahead.
I guess when your point with shrinking was so you can cut out inefficiencies and get rid of things earning less than your cost of capital.
It's not just inefficiencies, right? These might have been good stores when you opened them, but the world has shifted around you. So it's not just inefficiencies, but businesses can sometimes turn bad. What used to be a good business, having a store on Times Square, is no longer a good business. And what you're reflecting is as the world changes around you, maybe the best thing to do is get out of those businesses, which will mean shrinking. Okay? And for many mature companies in old businesses, the best path forward is to shrink. You're a steel company and you talk about growth. I'm running out of the door right now because you know what the return on capital in steel companies is for the last decade? 3 to 4%. I don't want you to grow. I want you to shrink. In fact, I have a valuation of a company called Severstal, which is a Russian steel company, a Russia-based steel company. If you get a chance, go to my website and type in Severstal. It's the most fascinating valuation I've ever done. It's a valuation I did, I think in 2015 or 16. And when I value the company, its revenues had actually shrunk by 50% over the previous 5 years. Now, what's your first reaction when I said revenues have shrunk? If you're thinking in terms of any kind of good, bad, that's bad, right? Revenues are shrinking. You know what Severstal did? Severstal was, as I said, a Russia-based steel company that was very caught up in growth in the first part of this century. In 2000 and 2010, they were growing everywhere. They became a multinational steel company when steel was a good business because China was growing. They were buying steel like crazy. Around 2010 or 11, the business started to shift. Margins started dropping, returns started dropping, prices were lower. And Severstal realized it was happening. But here's the thing that Severstal faced. In Russia, their business was still a very good business. Their margins were like 18%, because the rest of the world was 6%. And nobody came into Russia. They didn't want to compete in Russia. So basically, they had this domestic market that was a great market with high margins and high returns. You know what that 50% shrinkage was? Severstal basically sold off their businesses in the rest of the world, got top dollar for them, went back to being a Russian steel company with returns on capital that were double what the rest of the market was making, much higher than the cost of capital, margins that were 3 or 4 times higher. And I said, this is a perfect example of what a company should do when circumstance bad. Because you know what? This is not permanent. If steel comes back, Severstal can go back to growing, but that should be the way we think about growth is, hey, growth by itself is not what I want, but growth with good returns is what I'm looking for. So it's that's what I meant about these mature companies. Kraft Heinz, come on. The days of buying 57 types of crappy ketchup and cheese that stays liquid for the rest of eternity are behind us. I don't think they're going to rediscover some magical path to make us buy those. So maybe you can live off the 65 and 70-year-olds who keep buying your products, but don't go trying to get 20-year-olds to buy into it. It's not going to work. It seems defeatist, but sometimes you live to fight another day. And this is basically giving your shareholders the money. So go fight a battle in a different arena. In this arena, our chances of winning just dropped off. So let's talk about decline and distress. Most depressing valuations are businesses where you think your company is in decline. Revenues are dropping, margins are shrinking. So when I ask those questions about, what are your cash flows from existing assets, here's what you're going to see. Revenues are flat to declining, margins are shrinking. When you look at your growth, you're saying, what growth? My best days are behind me. When you look at risk, depending on what you're shutting down, your risk profile could be changing. And when I ask you, when will you be a mature company? You laugh and say, that was 20 years ago. I was a mature company. Now I'm beyond mature. I'm looking at something much more dangerous I might not make. So with declining companies, the first problem to overcome is a psychological problem. In fact, when I talk to equity research analysts around the world, I ask them a very simple question. When was the last time you valued a company and put in a negative growth rate? You know what the answer to that is? There are people who valued companies for 40 years. Never once have they valued a company with a negative growth rate. That strikes me as weird because we do know that some companies shrink. So you think, why? Because it doesn't seem right. When I ask you to put a -5% growth rate in year one, and you think that doesn't seem right because I think as human beings, we're hardwired to be optimists. And this is kind of pushing against every button in our system that says you can't do that. But the reality is, if you have a company in a declining business, and this is Manav's question, you have a company in a declining business. The best thing to do is to not fight decline, but to go with it, shrink as a company and essentially go away. A lot of fossil fuel companies face that future now, right? This is not a cycle anymore. You may be in a trend line where there is no good cycle left. You might have a spurt in oil prices here and there, but long term, you're looking at decline. So these companies, they're run by sensible managers, will actually get smaller over time, which is fine. Maybe they can find a smaller version of themselves that can stay on as going concerns. Maybe there's a subset of the businesses that's still solid. But here's your challenge as an investor. What if this company is run by an ambitious CEO who wants to be the next Steve Jobs? This is your nightmare scenario, right? Because now you have a company in a declining business. What's this person trying to do? He's trying to make this company the next Apple. He's going to make gamble after gamble, acquire, spend billions of dollars. So let's talk about being realistic. If you factor in what you see in a business and bring it in. Here's what your valuation is going to look like. This was a valuation of JC Penney in more optimistic days. And when you see my numbers, you're saying, this is optimistic. You should see my JC Penney valuations now to see what pessimism looks like. So this was when they were already starting in their decline. They just hired this guy from Apple, if you remember, that was going to turn JC Penney's around, set prices. I didn't for a moment believe that that was doable. And because their fundamental business was itself in trouble. So here's what I did to value JC Penney. So this wasn't a recession time. This wasn't like 2020 COVID. This was actually in good times. The scenario I saw unfolding for JC Penney was that revenue growth would shrink. This is my optimistic scenario, is shrinking revenue growth. That margins would improve as they shrunk the growth. Why? Because they're shutting their least profit. When I talk about shrinking here, it's coming from shutting stores down. So they're starting with the least efficient stores first and shutting them down. And as they shut them down, two things happen. The margins of the remaining stores improve because you've shut the worst stores down. And to the extent that you can recoup some of the real estate value, because some of these stores have leases and the lessor is willing to pay you money to go away, you actually get some divestiture proceeds, some liquidation proceeds. So what you see here are two things. One is declining revenue growth. And when you look at reinvestment, you see a negative number. You're saying, what's a negative reinvestment? That basically means that you're not just not reinvesting, you're actually getting money out of the business as you shut stores down, as you get out of the business. So it kind of reverses what you see in a typical valuation, but it reflects what I saw for JCPenney. So with my story, and I'm calling my optimistic story because I think eventually they're going to find a smaller version of themselves where there are some parts of the country where JCPenney will still succeed. And that residual JCPenney will be able to earn solid margins and essentially have growth in perpetuity. But it's a much smaller version of itself. So basically what I'm doing is I'm taking a company, shrinking it to the point where I think it can become a sustainable company, and that gets reflect my terminal value. But there are two variants in this terminal value you can take, because this is a fairly optimistic story of a JCPenney that continues in perpetuity. Let's assume that you think that your revenue growth shrinkages will not stop by the time you get to year 10. It's going to continue at 2% a year forever for the rest of eternity. In other words, you're going to get minus 2% growth. In your terminal value calculation, you can put in a negative growth rate forever. I mentioned when we talked about terminal value. So if you're in a business that's shrinking that you think will keep shrinking forever, the first thing you can do is use a negative growth rate in perpetuity. The other is if you truly feel down on this business, you really don't think there's a future, you know what you can do in year 10? You can shut the business down, get a liquidation value, maybe based on book value or whatever, and make that your end number. You've got to leave that door open if you're valuing a company in a bad business, that you can't just put 2% growth, do the things you do for a healthy company, for a company that you think is facing the throes that come towards the end of the life cycle. Any questions on declining companies? So I would expect that some of you have picked companies where you're looking at decline over time. That decline is going to show up as revenue shrinking, margins be getting compressed. But I'm going to add something to this company that can make it potentially something that can blow up on the company. Let's suppose this company that's shrinking, and its margins are under pressure, also has a lot of debt. You see what the other thing you have to worry about here is, will I make it to year 7 or year 10 or whatever you think will be a steady state? And this is what we talked about. If there's a chance your company will not make it, there is no way to make a discounted cash flow valuation reflect that concern. You know how much pushback I get on that? So why can't I just raise the discount rate? Because discount rates have to go to infinity, right? If your imminent demise is tomorrow, how high would the discount rate have to be to make your value go away? Discount rates are blunt instruments. They were never designed for this kind of risk. And when you have a company like this, you have no choice but to do a traditional DCF, but not stop that. Then I have to ask follow-up questions. One is, what is the chance I will not make it? That failure probability. And second, you got to complete the picture and say, what will my company do if it doesn't make it? Will it liquidate itself? If it liquidates itself, what will people pay for its assets? So I'm going to use an example to kind of illustrate this from 2009. It's a company called Las Vegas Sands. It's a casino company. And here's a couple of things about casino companies that are worth remembering. They're usually run by megalomaniacs. You take any casino company, and this one common feature is casino companies are run by, Steve Wynn, Sheldon Adelson. And it's part of the story, megalomaniacs, and they all have big visions that goes with being a megalomaniac. And Las Vegas Sands was actually one of the most successful casino companies of the last decade, 2000 through 2008. They opened up new casinos in Vegas, in Macau. In Singapore, they built this, Marina Bay Sands, which is this big boat-like hotel, huge. Every one of these is a huge infrastructure investment, costing hundreds of millions of dollars. And what are the two ways you can raise capital? You can raise equity or you can raise debt. Here's where the megalomania comes in. Sheldon Adelson is the lead shareholder in Las Vegas Sands. He actually owns about 51% of the shares. 51%, hold on to that thought. As Las Vegas Sands builds these new casinos, they borrowed every single dollar they needed rather than use equity. Do you see why they did not want to use equity? Sheldon Adelson owns 51%. You issue equity, run the risk of losing control. If you're a megalomaniac, that's the last thing you want. So in the first 8 years of that decade, between 2000 and 2008, they built a casino, they borrowed money, borrowed more money, built another casino, so their debt is going up, but nobody worried. When times were good, they said, this is amazing. And then the 2008 crisis hit and the bottom fell out. It fell out of their operating business because people stopped coming to casinos. And because they owed so much money, the bottom fell out of that part of the business because everybody wanted to get paid back. So this was a valuation I did in February 2009 when there was talk floating around that Las Vegas Sands might not make it. Why? They had all this debt payment coming due, people are concerned. So that's the noise I'm hearing around me. I sat down and did a DCF of Las Vegas Sands. And I did everything I was supposed to do, right? To fix a troubled company, I improved their revenues. That's people coming back to casinos, margins improve, the debt ratio gets paid down, so you don't have this dangerously high debt ratio. All completely plausible. And if they do all of this, the value I said per share was about $8.12. So this is a discounted cash flow valuation, assuming they recover, debt gets paid down, they become a healthy company, they get to nirvana, the big terminal value, $8.12 per share. The stock was trading at $4.25. So ask me the question. Did I buy the shares, right? Looks tremendously undervalued. I wasn't even tempted, which led to some soul searching. Because the question I'd ask myself is, what is it that's holding me back? You know what was holding me back? What was the noise I was hearing while I was doing the valuation? That they wouldn't make it. This is the value per share if they make it back to health. But what if they don't? What happens then? They'd have to sell their casinos. To whom? I mean, are you in a position to buy a casino? I certainly am not. So you know who'd have to buy the casino? Wynn Resorts, and they're in trouble too. Every one of the casino companies are in trouble. So if they actually get pushed into liquidation, I can almost guarantee you my equity is going to be worth nothing, because by the time you sell these huge infrastructure investments at a fraction of what you paid for them, there is zero chance that I will get paid. So I decided that I'd assess the chance that they would not make it. And here I got lucky. Las Vegas Sands had bonds outstanding. This was actually a 7-year bond with a 6.375% coupon. Normally, the way we price bonds is we take the promised coupons and the face value, and we discount them back at a risk-adjusted rate, like a cost of debt. That's how we price a bond. I'm actually going to reframe this pricing slightly. Instead of taking the promised coupons, I'm going to take the expected coupon. You're saying, what's the difference? To get the promised coupon, what has to be true? Your company still has to be around, right? So I took the coupons every year and multiplied it by a probability that my company will be around. You're saying, how are you going to come up with it? Hang in there just a moment. So that's going to give me my expected coupon. And because I've adjusted the coupons for risk, guess what I discount these cash flows at? Remember the certainty equivalent approach? You discount back at the risk-free rate. So I took the price of the bond, I took the promised coupons, I took the risk-free rate. The only number I don't know in this equation is the probability that the company will be around. I used Excel's solver function to solve for that probability. And I got back an astonishing, a mind-boggling number. Based on how the bond market was pricing Las Vegas Sands bonds, it looks like there's a 77% chance that Las Vegas Sands will not make it. So let's complete the story. There's a 23% chance they will make it, and if they make it, my DCF value is $8.12. The remaining 77% of the time, you know what my equity is going to be worth? They owe about $7.5 billion in debt. There is zero chance if they get liquidated that I'm going to get any money in my equity. My equity is worth zero if they get liquidated, $8.12 if they don't. My expected value was $1.92. Now do you see why I put that failure probability in? If you have a company like Las Vegas Sands, and this is not just Las Vegas Sands. Last year when I was valuing Boeing at the peak of COVID in March 2020, let's face it, Boeing is a company with long and illustrious history. It's still only one of the two companies can actually deliver aircraft that airlines can use. It still has this duopoly market. So can Boeing make it back? Absolutely. And in this valuation, I drafted a path that will make it back, improve margins, the 737 MAXs in your rear view window. But I had to be realistic, which is March of 2020, there was a very real chance that Boeing wouldn't make it. You're in the midst of a crisis. Go back and read the news stories about Boeing on March 12th, when they actually had to use a line of credit that nobody thought they would have to use because they were so close to running out of cash. Probably that I attached that they wouldn't make it was 20%, which is huge for a large company that's been around a long time. But I have to do it. Without doing this, I'm going to overvalue Boeing. 3 weeks later, when I revalued Boeing, the 20% had become 10%. You know what had happened? Because the Federal Reserve on March 23rd announced that there were going to be a backstop on private lending. It's a big announcement they made. And a week later, that opened the floodgates to private lenders coming back. And Boeing was able to raise $2 billion, or more than that, $10 billion in corporate bonds in an issuance that kind of shifted the market entirely. So just like every other input, I'm willing to revisit it. But when I'm in the midst of a crisis, that's a number I constantly think about, not just for my distressed company, for every company. Now, from a practical perspective, you're saying, when I'm doing my company, how do I attach that failure probability? Because of all the numbers I use in valuation, that's the number I give you the least guidance on. I'll give you the easy scenarios. If your company has a bond rating, your life just got a little easier. And here's why. If we have a history of what percentage of companies in each ratings class have defaulted over time. For instance, if you're a BBB rated bond, which is an investment grade bond, less than 10% of bonds with BBB ratings actually default over the following 10 years. If you're single B rated, that number can climb to 25%. If you're triple C rated, it can be 35%. So based on history, if you tell me what your rating is, I can tell you, here's the chance you will not make it. So your company has a rating that can be used to come up with a failure probability. So for older companies like Boeing, and for GameStop, that's what I did. For GameStop, I actually looked up the bond rating, looked up the probability of default based on it, put it in. But if you're valuing an Airbnb, a company that doesn't have a bond rating, you're kind of on your own, right? And there it gets much messier. And now all I can give you is guidance, which is you're going to look at how close to profitability the company is. That's a factor in what kind of failure. And second, you're going to look at their cash balance. You never do that in public. You're saying, who cares what the cash balance is? You know how most young companies end up going out of business? They run out of cash. That's it. Their checking account goes to zero. They can't write any checks anymore. Nobody can get paid. The game is over. So I look at cash balance as kind of a rough proxy for how much should I be worrying about this company in terms of failure probabilities. But any assumption you make is still an assumption. Ignoring it is also an assumption. So that's why make your best judgment on that failure probability. You need to bring it in. Which brings me to emerging market companies. Again, with emerging market companies, the questions remain the same. What are your cash flows from existing assets? You still have to go through cash flows. You have different accounting standards. You might have to wrestle with that. If you're in a country where companies are not fully disclosing what's happening, that's more problems. When you look at growth again, the growth rates of these companies, one of the things you worry about is how the macro environment they're in can affect the company. So you're a Turkish company, you might be the best run Turkish company there is, but if Turkey goes into another crisis, it drags you down. When you talk about cost of equity and cost of debt, remember that country risk premium that shows up. So with emerging market companies, whether you like it or not, lurking in the background is the country, right? It can affect your valuations. So here's the bottom line. When you're valuing emerging market companies, you can't avoid it. You have to deal with country risk. But my advice to you is use a scalpel, not a bludgeon. Pick one place in the evaluation where country risk shows up. And I picked my place. It's going to be in my equity risk premium. And I'm going to bring in my worries about country risk there and then just let it go. Because if I take every input and make it an assessment based on country risk, I'm going to end up double counting, triple counting, quadruple counting country risk. You know what I mean by every input? If I increase my beta because you're an emerging market company, and I also lower your cash flows because you're an emerging market company, I'm punishing you multiple times for the same sin. And second, the currency you choose to value a company is kind of irrelevant. You're valuing an emerging market company, pick a currency and just stay consistent. You're valuing a Nigerian company in Nairas, good for you. But if you run into trouble in Naira and you want to value it all in euros, that's perfectly okay too. As long as you stay consistent, the value you get per share will be the same no matter which currency you choose to take your stand in. I know it sounds abstract. You're saying that can't be true. If I value a company in rupees, I'll get a different value than if I valued in dollars. I don't think so, not if you're consistent. In fact, a few years ago, I valued a company called Infosys, one of India's largest outsourcing/software companies. And I first valued in Indian rupees. And I'll give you the, and again, I valued in US dollars. Same company, same point in time, rupees and dollars. So I'll give you the good news of what happens when I switch from rupees to dollars. The good news is my discount rates all get lower. A dollar cost to capital will always be lower than a rupee cost to capital. We talked about why, right? It's inflation differentials. But here's the bad news. When I switch from a rupee cost of capital to a dollar cost of capital, every other input in my valuation also is affected by that same inflation differential. My 12% growth rate in rupees becomes an 8.78% growth rate in dollars. Why? Because I took the inflation benefit out. I get lower discount rates and lower cash flows and lower growth rates. The net effect is at the end of the process, the value per share that I get is exactly the same to the nth decimal point when I switch currencies because I'm staying internally consistent. So if you're running an emerging market company, try in the local currency. It's always a good exercise. But if you really, really, really are getting frustrated trying to get, valuing a Venezuelan company, I wouldn't even try Bolivar. You're going to pull your hair out. You're going to go crazy. Just value in a different currency and stay consistent with that currency. Which brings me to this other issue that is not just restricted to emerging market companies, but it's bigger with emerging market companies than with non-emerging market companies, which is this corporate governance drag, right? Which is in most emerging market companies, the rule rather than the exception is that you have very little power in the company, whether it's family groups or consolidated companies, that you have very little say in how the company is run. Which often leads, I get emails from people in emerging markets saying, I'm valuing an emerging market company. I know the management is entrenched. It's a family group company. There's nothing I can do. Should I be discounting? And as we started the class with, if you do it right, you shouldn't have discount. It should already be in your valuation. So I'll give you an example. It's a company called Tube Investments. It's actually a South Indian company, company that I've known about for a long time. My family's been connected to people in the company. So a few years ago, when I came back to Chennai for some reason, I was asked by the family group running the company to come in and do a valuation of Tube Investments and the motivation was very simple. They felt the market was being very unfair to the company, and because they were trading at like 4 times earnings or something, or 5 times earnings. And they said, we're growing, we're this healthy company, there's no distress risk. Why aren't we trading at a higher price? Is the market completely, So they were looking for an answer of, if you disclose this and your price is going to pop up. They thought that the market was not getting them. So I decided to value the company. As I value the company, you can probably see where the discount is coming from. So let's start looking at the most recent year. They made money. They made 4.4 billion rupees, but their negative free cash flows, they reinvested a lot. It's not a bad thing, right? Reinvestment is good. In fact, the reinvestment rate had been pretty high leading into this valuation. So I gave them a 60% reinvestment rate, lower than last year, but reflecting their average reinvestment rate. The return capital is about 9.2%. So you can see what they were saying. We're growing at 5.5%. So the growth was pretty healthy. Now, whenever you look at growth, what's the first thing you check to see if it's good growth? You compare the return on capital to the cost of capital. And in rupee terms, and this was a long time ago, my cost of capital for the company was 16.9%. They're growing, they're reinvesting a lot, but they're growing by reinvesting badly. You know what I did in this valuation? I assumed that nothing would change. You know why? Because they didn't see a problem. They said, we're a money-making company. Do you see why you've left the standards really low when you define success as we're making money? But they're making money. They're just not making enough money given the capital invested in the risk. They don't think there's a problem. Why would they change? So I left the return on capital at 9.2%. And I gave them all the benefits of maturity, lower cost of capital. The value that I got with this status quo was about 62 rupees per share. Stock was trading at 102 rupees. They were not happy because they wanted me to come in and say, well, market's making a mistake. It's trading at 102. You should really be trading at 180. So they're expecting a much higher number. I actually came to the lower number. I said, you know what? The market's probably doing you a favor, trading you at 5 times earnings. You should probably trade at 3 times earnings. They were horrified. And then they threw in all the usual things that they thought would increase value. So what if you gave us a higher growth rate? And they say, how exactly are you planning to grow? Oh, we can reinvest more. We can do a lot more acquisitions. So I actually didn't answer the question. I just went to the Excel spreadsheet, made the 60% at 112%. The good news is the growth rate popped up. Guess what happened to the value per share? It went to $45. They discovered very quickly that pushing the reinvestment lever was not doing much. In fact, I let them work it out. What's the number you need to move to make the value go up? You need to move this return on capital up, right? The cost of capital you could try to reduce, but there's not much room to run. You've used debt pretty much fully, essentially. So we played with this, and finally, I said, can you make a higher return capital? They went back and forth, and they said, yeah, if you did this, this, and this, maybe we can make about 12%. Even at 12%, they're still lagging the cost of capital. But there's some of the businesses, that's about as much as they could make. I said, okay, if you can make 12% in your new projects, holding all else constant, your value goes to $84 per share. If you can make 14% return on capital, go to $102 per share. But if you lower the reinvestment rate to 0%, your value goes to $112 per share. Why you're stuck in these bad businesses? Everything you do that you think is creating value for you is actually working against you because you're investing in projects that don't make their cost of capital. And if you can magically improve the return on capital on your existing projects, not just your new projects, remember that's much more difficult to do because these are investments you've already locked capital in, even better, your value can go up. But the point I'm trying to raise is I've already built bad corporate governance into this valuation because I'm essentially allowing them not just to stay in a bad business, but to keep growing, which would be completely counter to their shareholders' interests. And if there were good corporate governance, what would happen? An activist investor would pop up saying, what the heck are you guys doing? And create change. There's no chance of that happening here because the family has firm control. That's where it matters, right? When you have a well-managed, well-run company, the fact that you have no control at Facebook, you don't feel that bad about it. You know, what can I do? What am I going to do differently? The worse run a company is, the more of a drag there's going to be in value. In fact, it's since Viacom is in the news, you know, there's a time when Viacom was controlled by a guy called Sumner Redstone. He was a legend in this business, a man who built up lots of businesses. And Viacom was one of those first companies to have two classes of shares. And Redstone owned the controlling interest of the company through the voting shares. I remember the late 80s talking to analysts about Viacom. And they would, I'd tell them, look, how come you're more concerned about the fact that Viacom is controlled by this individual and you have very little chance of introducing change? And they say, but Redstone is such an impressive guy, such a great manager. What difference does it make whether we have? You know what changed? Sumner Redstone got really old. So those of you who followed the Viacom story, Sumner Redstone actually got to the point where he had, I think, dementia. They started hiding him, but his daughter took over the company and claimed to be getting directions directly from Redstone. He couldn't check. She controls the company now. For people who invest in the Facebooks and the Googles of the world and say, don't worry about the fact that you have no good corporate governance, my response is, you're locking in this loss of control in perpetuity. What happens if the person you're giving the power to turns on you or something happens? Because this is not just for the next 5 years or 10 years. I think my shareholders have become far too cavalier about giving up voting rights. We've accepted it, right? It's now the rule with every young tech company that goes public. It didn't used to be the case. Microsoft and Apple went public. They were tech companies. They didn't create two classes of shares. Why are we allowing the Facebooks and the Pelotons and the Airbnbs to do this? I mean, the only thing I can explain it with is founder worship. You know what founder worship is in Silicon Valley? Founders are put on pedestals. They're like godlike creatures. These are human beings. They have their own flaws. We let them have complete power. Sooner or later, it's going to blow up on our faces. And we're going to see it happen in quite a few of these companies. Which brings me to the last issue with emerging market companies, which is cross-holdings. Again, not restricted to emerging market companies, but more of an issue with emerging market companies reflecting their histories of being family groups that used to be private companies. So the example I'm going to use, you can't even read this page, so don't even try, is the Tata Group. I mentioned the Tata Group earlier today, but basically it's the Tata Group. In April of 2010, I valued 4 Tata companies: Tata Chemicals, Tata Motors, Tata Steel, and Tata Consulting Services. I won't bore you with the details, but 3 of these companies are pretty mature companies: Tata Motors, Tata Steel, and Tata Chemicals. And Tata Consulting Services is a software company with a lot of growth and high margins. But here's the part of the story I wanted to focus on. After I finished the valuation of each of these companies, I faced a challenge. And here was the challenge. With Tata Motors, Tata Steel, and Tata Chemicals, there was a huge percentage of the company that was locked up in other Tata companies, cross-holdings. Tata Consulting Services was much smaller. In fact, to show you the difference, here's what I got. The blue is my free cash flows to the firm discounted the cost of capital value of the operating assets. The red is the value of my cross-holdings. Notice something interesting? Tata Chemicals, Tata Steel, and Tata Motors, I get 47, 40, and between 37 and 47% of the value comes from cross-holdings. Tata Consulting Services, I get only 5% of the holding from cross-holdings. Prithvi, You're probably familiar with the Tata Group. Are you?
Yep.
How do you explain this difference? Why does Tata Consulting Services get so much less of its value from cross holdings than Tata Motors?
Is it because of the margins, or historically they have been like in multiple companies?
Let's start with historically. And in 1979, if you looked at the Tata Group, most of the group was still privately owned. It wasn't publicly traded. So think of the old Tata Group, right? Family group, Tata Motors, Tata Steel, Tata Chemicals. In 1966, Tata Motors has a really good year. Tata Steel needs to build a new factory. You know what the Tata family did? They owned all the companies anyway. They took the money from Tata Motors, put it into Tata Steel, and the accounting transaction was Tata Motors would be given these shares in this hypothetical, nobody really cared, but it showed up as shares. You're right, it reflects a history. Tata Motors, Tata Steel, and Tata Chemicals have been around for decades. And for most of that history, they were private companies drawing on each other's resources. TCS is the youngest of the companies. So by the time it went public, the rest of the companies are already public. You didn't have this intra-group capital transfer. So part of that is just a reflection of history. What I'm trying to say is, don't think of this as some kind of conspiracy mounted against you. It reflects their history. But it does also mean that I'm far more willing to act on my valuation of Tata Consulting Services than I am in Tata Motors, Tata Steel, and Tata Chemicals. You know what I mean by acting on it? For instance, let's suppose I found Tata Steel to be undervalued. The price is lower than the value. I'm going to be far more reluctant to pull the trigger because almost half of my value comes from cross holdings. And I really don't know what the value of these cross holdings are because I've got to take the accountant's word for book value. I'm doing all these sloppy things, right? I'm not doing cash flows. When you get a big chunk of your company's value come from a cross holding where you can't look inside the cross holding, it doesn't mean you can't value the company, but it does mean that you're going to be less willing to act on that valuation because you feel less confident about what that value is telling you. So I don't know how many of you are valuing Samsung, you'll have the same issue. A lot of Asian companies, this is going to be a standard issue. I'm not saying stop the valuation, switch companies. I'm just saying I will understand if you're more reluctant to put a buy recommendation based on undervaluation. If 30% of your value comes from a cross holding and you really can't see what's in that cross holding. And final point is, when you talk about truncation risk, we looked at one kind of truncation risk, distressed companies. Truncation risk is the risk you will not make it. With distressed companies, it can come from debt. But truncation risk can take other forms. Now, a few years ago, there was an publicly traded Egyptian hotel company, which had this huge luxury hotel, I don't know where in Egypt, but a terrorist attack actually leveled the hotel. You say, why did they have insurance? Try buying insurance in parts of the world and you're basically going to give up. It's so costly, you can't even do it. They didn't have insurance, the company was done. Or you have a company in Venezuela. In fact, I remember a student of mine who went back to Venezuela and he called me and he says, I have a business, it's doing very well. And I'm worried. And I said, why would you be worried if it's doing really well? He's saying it's doing too well. And I said, why would that worry you? He said, because we're doing so well, it's attracted the government's attention. We're afraid we might be nationalized. You see why this is a truncation risk? When you get nationalized, what happens? Your value as a shareholder is essentially going to be replaced with whatever you get in nationalization. You're saying, won't I get a fair value? I don't know how many companies that have been nationalized you've actually seen, but the essence of nationalization is you don't get fair value. You get a fraction of it, maybe half, maybe 3/4. You can sue as much as you want, but that's a reality. So I'm going to leave you with one final valuation, kind of a boring valuation, with one of your valuations of the week. In case you saw it, this might be overlap, but it's a valuation I did of Aramco when they went public. And the reason I picked Aramco when they went public is for a simple reason, which is this is a company that the minute they went public, almost overnight became the largest market cap company in the world. And it's a very simple company to value, right? It's 300 million barrels of oil under the Saudi Arabian sands with a very low, with the lowest cost of extracting oil in the world. So when I sat down to value the company, I said, should I even try to value this company? Using traditional, how you stop up to year. There's really no terminal rate. It's 50 years of oil under the ground. So I actually value the company using a very simple approach. Initially, when Aramco went public, they actually guaranteed a dividend of 75 billion in year one. 75 billion, that was a promised dividend. And we assume that this dividend can be delivered, growing at 1% inflation rate. The present value is $1.629 trillion. You can just collect the dividends and take them. So this is one of those few cases where you could use a dividend discount model and pretty much get close to the truth. But the question is, can they afford to pay 75 billion? Easiest way to answer that is with free cash flows to equity. And their free cash flows to equity were actually 108 billion. They could actually afford to pay more than 75 billion in dividend. So in the second valuation, I took their free cash flow to equity. I actually used a higher discount rate on it because these cash flows are more uncertain. But the value that I got was about 1.65 billion, very close to my dividend discount model value, 1.65 trillion. But here's the problem with both those valuations. Those valuations assume that I will have claim on those millions of barrels of oil under the ground, and there will be no truncation risk. The biggest risk you face when you buy Aramco is, it's not that they can't sell the oil. They will always be able to sell the oil because even if oil prices drop to $20 a barrel, they will actually be the only oil company in the world that can actually sell oil at that price. So I'm not concerned about them selling the oil. But Aramco is really not a company. It's actually, you're investing in a country. You're investing in the Saudi regime. So the worry I had was, what if there's something that happens to that regime? Let's take an extreme scenario. Let's assume you think there's going to be regime change next year, a violent regime change, and that Aramco will be nationalized and be given nothing. There goes your 1.6 trillion, right? Well, that's extreme. Here, I actually attached a 20% chance of a regime change. Don't even ask me how I got it. I just made up a number. I'm not a political scientist. But Aramco, you really need a political scientist. You don't need an econ degree. Somebody who assesses the chance of regime change. And I assume that if there's a regime change, there will not be a full nationalization, but they're going to prune how much I will get in cash flows because they have all this other stuff they will want to do with it. And I revalue the company at about half what I got. So my expected value was a weighted average of what I got is 1.65 trillion using my DCF value. And what, I don't know how many of your companies have regime change as a possibility, but I'm going to leave you with that because next session when we start, we're going to start with banks. And we're getting, as I said, very close to the end. So make sure you downloaded the second lecture note packet because we'll be starting on it on Wednesday and bring it to class with you, but I will see you there.
Professor?
Yep.
Have a question on something you mentioned earlier about tube investments where the reinvestment rate was 60%. And I think you said if you drop that reinvestment rate, the stock price goes up.
The value will go up. Yeah.
The value will go up. I was wondering, why does that happen? Like, what drives the growth at that point if you're not investing?
Zero, there's no growth. Basically, you reinvest less, you have lower growth, but the benefits you get from having higher cash flows outweighs the fact that you have no growth. Right? There are two drivers here, right? The growth that pushes up your earnings, but you're subtracting out the reinvestment to get that growth to get to free cash flow. So when I lower the growth, your earnings will come down, obviously. Revenues will go down, but your cash flows will actually surge because you don't have to reinvest to get that. And because you're earning a low return on capital on that cash flow, the net effect of cutting back on growth, and this is what I said at the start, reducing growth may actually be the best thing you can do. Shrinking as a company can actually make your value higher because you're getting out of bad businesses.
Got it. Thank you.
Okay.
Professor, if you have a minute, could you give me some guidance on my,
Sure.
Yeah, so I'm valuing a company called InPost, and it's in Poland, and it makes these sort of like special box type things where online platforms can drop off their packages.
Okay.
And and the online e-commerce industry is booming in Poland because they have Allegro, which is the major player there, and now Amazon is coming in. And a lot of the value of the recent value of this company comes from the fact that they've just signed a contract with Amazon. But I can't decide if this is a good thing or not, because there's a possibility that
nobody ever enters an agreement with Amazon and ends up a winner at the end, right? Like logistics companies, because Amazon will squeeze you. That's their model, and they will replace you.
And they're
That's
stealing.
what they did. Yeah.
So
I think that's the reality. So it's good to be skeptical of those stories. Yeah.
So I was thinking of doing like 2 valuations, one where they go on for 10 years and into perpetuity, and one with a smaller life where Amazon pushes them out, but I didn't know what to use for weights. And I was thinking 50-50 just because I can't think of anything else.
I think you can look at other companies that have kind of played this game with Amazon. I think 50-50. I mean, I think that's as reasonable a set of weights as any. If you're completely, that's a diffuse property where you have nothing to guide you. 50-50 is where you go. Now, to the extent that you have some history you can look at, you can put some, but if you can't find any history, stay with the 50-50.
All right. Thank you.
You're welcome.
Okay.